Yeah, so inflation is the general increase in the um, aggregate price level. The general increase in the aggregate price level. So, see, what is just trying to say there is, well, everybody don't mind inflation. Inflation one economy. Good morning. Inflation one economy right now. So, like everybody know it's my inflation. Yeah. So, but then one thing I want us to notice that if you have two commodities, the economy, see price one very cinema increase. Like if you have 1,000 commodities, but only the price of two of the commodities don't increase. So, are you experiencing inflation? No, Olade. Yeah, so what I was trying, yeah, I was trying to say that if there is an increase in the price level, if there is an increase in the price of two goods, just two commodities in the economy, the economy already produce about 1,000 goods. So the increase in the price of those two goods, does it constitute an inflation? They are just, yeah, exactly, are just two goods. If there are 1,000 goods, 1,000 goods in an economy, economy can produce a lot of things, so about 1,000 products. But two of the products, owó wọn ti lé, ó ti gbówó lórí. So I'm now saying that is that economy experiencing inflation or not? Okay. So that's the point I want us to drive at. It is not general. So, lè sọ pé inflation wà. That's true. So, lè sọ pé inflation wà tí àwọn aráàlú ò dẹ̀ feel ẹ̀. So if there is an increase in the price of just two of the commodities, then àwọn aráàlú lè máa aráàlú púpọ̀ gan ní feel ẹ̀, àfi àwọn tó ń ra ọjà yẹn gangan náà nìkan náà ló máa feel ẹ̀. So that's not yet, an inflation. So proceeding from that, we now have inflation is the continuous increase in the price level, blah blah blah, like that. Then due to a number of factors. So kí ni àwọn nǹkan tó lè jẹ́ kí inflation wà ní economy? Um, there then I think that can just take us into types of inflation. So there are two types of inflation. What was CB? But I want you to take note of that. That there are two types of there are many types of inflation actually, but then there are majorly two types. So you have demand pull inflation, demand pull, demand pull inflation, and cost push inflation. Demand pull. So, but it's sent in the chat box. So those are the two basic types of inflation in a given country. So there are still others. Any hyperinflation. So hyperinflation when from the word hyper, nǹkan tó wà aggressive. So when the inflation is increasing at a very rapid rate, when inflation is increasing in a country at a very rapid rate, so you're now having a hyperinflation. You have hyperinflation as well. Increases at a very rapid rate in a country. Then I think you should know about this one. Stagflation. Stagflation here. It is a period. It is a period of high unemployment and high inflation. So we mentioned like four like that. So if you're following Ecole, send the text not in the chat box for me to know if you are following because I know you are muted. So I just comment, just say something. Maybe I'm following or something to my follow. So that's that. So I was saying that demand pull inflation and cost push inflation, like they are like the biggest things. Well, we have another concept which is imported inflation. But by the time about the foundation of all of these things, they are actually um, as a result of either demand or cost push inflation. So what then is demand pull inflation? So demand pull inflation is the type of inflation that is caused by an increase in aggregate demand. Is a type of inflation that is caused by an increase in aggregate demand that is more than the aggregate supply. Demand pull inflation is the type of inflation that is caused by an increase in aggregate demand that is more than the aggregate supply. So in this case, the inflation arises because people have more money to spend than businesses have the capacities to provide for. In this case, inflation arises because people have more money to spend on goods and services than businesses have the capacities to provide for. So nǹkan tó ń really cause the demand pull inflation nílé. So I want to please I want to know if you are following. I want to know if you are following. Just maybe unmute yourself and talk, or maybe send me a text in the comment section. Okay, thank you. All right, thank you very much, man. So yeah, so nǹkan tó máa ń fa demand pull inflation ni pé àwọn èèyàn ní owó púpọ̀ láti ná, and so wọ́n máa oníkálukú fẹ́ máa ra nǹkan, like generally in the economy. So ẹni tó ń ra zobo fẹ́ máa ra zobo púpọ̀, ẹni tó ń ra kùnú, ẹni tó ń ra ilé, ẹni tó ń ra mọ́tò, etc like that. But àwọn businesses tó wà responsible láti máa provide àwọn kíní yìí, they cannot meet up along that particular period of time. So nǹkan tó bá dẹ̀ ti ṣẹlẹ̀ pé businesses cannot meet up with the demand, ìwọ̀nba tí businesses ní wọ́n máa gbówó lé. So ẹni tó ń tà nǹkan ní 5k, tẹ́lẹ̀tẹ́lẹ̀, good, yeah, well done sir. Ẹni tó ń tà nǹkan ní 5k tẹ́lẹ̀tẹ́lẹ̀ tó wá rí pé okay, àwọn tó ń wá nǹkan tó ń fẹ́ tà bọ́ ti ń pọ̀ ju nǹkan tágbára tó ń ká lọ, ó máa gbé owó nǹkan tó ń tà sí 7.5. tó bá dẹ̀ torí pé mo tún ṣì ní more demand, á tún gbé sí 10,000. So at the end of the day, ẹ máa rí pé inflation máa wà in the economy. So that type of inflation is said to be caused by demand of people, by people having too much money to spend than businesses have to like provide for in terms of goods and services. Now, the question is it a problem for people to have too much money to spend? It is not a problem. It's not a problem. But the issue is businesses should also be able to provide for those goods and services that people are really demanding. So téèyàn bá lówó púpọ̀ dání, ìyẹn ò ń ṣe big deal. But ìgbà táwọn èèyàn púpọ̀ bá ní owó púpọ̀ dání tí wọ́n wá lè rí nǹkan tí wọ́n lè fi rà, àbí tí nǹkan tí wọ́n lè fi rà ò pọ̀ tó iye nǹkan tí wọ́n fẹ́ láti rà, then inflation máa bẹ̀rẹ̀. So that's the bad thing about it. And moving away from that, we're now going to cost push inflation. So cost push inflation is the type of inflation that is caused by rising cost of production. That is caused by rising cost of production. So nǹkan tó fa cost push inflation sí ẹni yẹn. So because businesses now have to pay more money, business now have to pay more money to be able to like continue to produce goods and services. Then wọ́n máa gbé ó lé nǹkan táwọn náà ń tà, right? And then at the end of the day, you'll be having an increment in the price of goods and services that people have to buy, because at the end of the day, àwọn tó ń ṣe òwò, they won't want to bear the whole cost, the whole increment in the cost of production. Wọ́n máa fẹ́ push ẹ̀, so kó má jẹ́ pé orí tàwọn nìkan ló wà. So wọ́n máa fẹ́ push ẹ̀ sáwọn customers, and how do they push it? Through increment in the price of their goods. So these are like the two fundamental causes of inflation, or the two fundamental types of inflation in a given economy. So one can be demand pull because people have a lot of money to spend, and then the other one can be cost push. And I've also mentioned other types of inflation here that, okay, hyperinflation. Hyperinflation can be caused by the foundation of hyperinflation is, let me just say, generally speaking, nǹkan tí inflation really mean, nǹkan tó really fa inflation ni pé nǹkan táwọn èèyàn fẹ́ rà kò tó nǹkan tó wà available. Nǹkan tó really fa inflation nìyẹn. Too much, like demand is more than supply. That's the fundamental reason for inflation. So whenever demand is more than supply, we don't know what causes, without even knowing what causes those things, right? There's going to be inflation. In the first case, demand pull inflation, demand curve, aggregate demand curve, yẹn máa shift síta. So you begin to have more aggregate demand than the existing aggregate supply. That causes inflation. For cost push, the supply aggregate supply curve yẹn máa shift wọnú. So that is aggregate supply will now be lower since the cost of production is more than nǹkan tó jẹ́ tẹ́lẹ̀. Nǹkan táwọn business lè produce ó ti kéré sí nǹkan tí wọ́n lè produce tẹ́lẹ̀tẹ́lẹ̀. So aggregate supply yẹn máa kéré sí. So even if the demand is the same thing, the fact that aggregate supply is lesser would mean that there's going to be an inflation in the economy. So like, so you just have that. So hyperinflation is just saying that okay, without even knowing what is causing the inflation, inflation in the economy is rising rapidly. So I think it is between maybe I think it is rising like between 10 to like 20%. So inflation that is rising between 10 to 20% annually, what you're not paying hyperinflation, 10 to 20%. Last year, price level was an inflation of 25%. Now, by the end of this year, an inflation of 45%. But in the next year, I think an inflation of 65%, 70%. So the economy is experiencing hyperinflation. Now, we also mentioned stagflation. Eléyìí, kì í ṣe inflation nìkan ni wọ́n ń pè ní stagflation. The stag tó wà níwájú ẹ̀, it means stagnancy. And what can make the economy to be stagnant? So an example of the symptoms of a stagnant economy is an economy with high unemployment rates. So stagflation is just a concept that is saying that an economy is experiencing high unemployment rates and high inflation at the same time. High unemployment rates and high inflation at the same time. So that is stagflation, right? And then the last one, imported inflation. Now, this is the inflation that is caused. Maybe I should type that. Imported inflation is the inflation that is caused when a country imports goods and services from countries already experiencing inflation. Goods and services from other countries already experiencing inflation. So ẹ wá gbé inflation wọlé láti ìlú onílùú wọ ìlú tọ̀dọ̀ tí yín. So táwọn èèyàn bá ti ra nǹkan ní ọ̀wọ́n láti tó ti ń gbé bọ̀, then definitely ọmọ àti láti tà ní ọ̀wọ́n sí ní ibi tí wọ́n ń gbé bọ̀ wá sí. So bí Nàìjíríà ṣe rí nsìn, kẹ́nìkan sọ pé òun rajà ní Nàìjíríà, òun gbé lọ sí another place. Bí nǹkan ṣe wọ́n Nàìjíríà, so by the time tó bá gbé lọ sí another place láti jèrè, tún máa ní láti fọwọ́ kún. So the economy there will be suffering from imported inflation tá a gbé wọlé láti ìlú onílùú. So if I hope these things are clear so that we can just go back to the slides. Àwọn kìíní yóò sínú slides, but like we said, sometimes the basis of education is not to pass exams. It's actually for people to know what they should know. Okay. So now I think the last thing here, maybe we should just read. Inflation affects two major functions of money. I'm talking about the second paragraph. Namely standard for deferred payment and store of value. So tẹ́ bá rántí pé a ṣe functions of money and standard of deferred payment tí wà láàrin ẹ̀, store of value náà dẹ̀ wà láàrin ẹ̀. Tẹ́ bá rántí kí la pè standard of deferred payment, tẹ́ bá ní à ń fi owó ṣe standard of deferred payment, so ṣé ẹ rántí nǹkan tí a pè? Yes, àná náà la ṣe. Okay. Right, it simply means that money is useful for you can buy things on credit and use money to pay for it later. So nǹkan tó ń jẹ́ standard of deferred payment nìyẹn. Adẹ̀ ṣàlàyé lánàá pé the reason why trade by nǹkan tá à ń sọ níbẹ̀ yẹn lánàá ni pé you can buy things on credit and use money to pay for it later. That's the meaning of standard of deferred payment. Buying things on credit and using money to pay for it later. Money makes it possible to buy things on credit láti ra àwìn ẹ̀dẹ̀sán ní ọjọ́ iwájú. And then we established that the reason why it wasn't working under the trade by barter system was because of the exchange rate. So nígbà tí ẹ bá ra nǹkan lénìí tí wọ́n ní àgbò kan ni ẹ máa fi exchange fún aṣọ ọ̀pá mẹ́wàá, agreement tàdé nílé nìyẹn. Màá tó bá dìgbà tó yẹ kí n sanwó yẹn, mi ò wá fẹ́ fún yín ní àgbò kan mọ́ torí pé àgbò tó ti léwó sí nígboro. So if I want to like use a ram to pay back my debt for clothes, I'll be paying more in value than the clothes that I bought. So ó dẹ̀ lè dìjà. So but money came to clear that issue in the sense that tẹ bá ra nǹkan láwìn ní 10,000 lénìí, ìgbà tẹ bá fẹ́ sanwó yẹn náà padà 10,000 tí ẹ jẹ iná lè máa san padà. So there's no issue with it. Kò sọ̀rọ̀ pé okay 15,000 lẹ́kọ̀ọ́ fún mi sìn, 10,000 mo yá lọ́wọ́ ẹ̀, 10,000 náà máa fún ẹ padà. So that's the way money solves the problem. That's if there is no interest rate. Tí wọ́n bá sọ pé okay o, mo yá 10,000 ní kò fi sọ 10,500 lọ́la. Even at that, it's still kind of better than ká ṣe àwọn jà láàrin ara wa pé irọ́ mi lè fẹ́ lágbo kan mọ́ ewúrẹ́ ló máa gbà ń sìn nǹkan kan bẹ́ẹ̀ yẹn. So that was what we said yesterday. Now today, how does inflation affect standard of deferred payment? So òun náà ni mo ti ẹ̀ṣẹ̀ ṣàlàyé yẹn náà wípé okay, nígbà tí ẹ bá gba tẹ bá gba nǹkan láwìn ní 10,000, nígbà tó bá dọjọ́ iwájú tẹ bá fẹ́ san 10,000 yẹn ní ìlú tí inflation wà, ẹni tó ń gba 10,000 lọ́jọ́ iwájú ẹ ti short change ẹ̀. So and báwo lẹ ṣe short change ẹ̀? Nǹkan tó lè fi 10,000 ṣe nígbà tó yá yín àbí nígbà tó tajà fún yín láwìn kò lè fi 10,000 ṣe mọ́ nígbà tẹ́ ń dá owó padà. So I don't know if you understand what I'm trying to say. At least I think you should understand it being I don't know. Ó ti yé yín àbí? Yes, so I think you should understand it. So ó lè di rọ́ńtó wípé irọ́ o, because 10,000 tẹ́ni yẹn gan fún yín nígbà yẹn kò lè ra ọjà tí ẹni yẹn rà. Tẹ́ bá ti sọ pé ẹ fẹ́ kó lọ sọ́jà fẹ́ lọ rà padà, owó yẹn ò lè rà mọ́. So bóyá nǹkan 5,000 ló máa padà rírà. So when ibi tí inflation bá wà, it affects the function of money being used as a standard of deferred payment. So if, money working effectively as a standard of deferred payment is in an economy where the price level is stable. Limited price level is stable, tí ò sí inflation, tí ò sí deflation. So that is where money is effective to be used as a standard of deferred payment. Now, I want the second function tí ó ń affect, which is the store of value. Money being a store of value. Nígbà tẹ́ bá save owó, ẹ save 1 million sínú account. Tó dẹ̀ di 2025 tẹ́kọ̀ fowó yẹn síbi àbí ẹ̀ tẹ̀ fowó pamọ́ sínú ilé. Okay, ẹ dẹ̀ gbé jáde ní ọdún tó ń bọ̀. This is August. Bí i January ọdún tó ń bọ̀, ẹ dẹ̀ ní pé okay o, ẹ fẹ́ fowó yẹn ṣe nǹkan. Ẹ máa realize pé nílùú tí inflation, even the way Nigeria is as it is right now, the worth of 1 million naira today is not likely going to be 1 million naira like even next month, tó sọ̀rọ̀ next year, with the way inflation is going. So 1 million lè padà ra nǹkan 500,000 àbí nǹkan 700,000 lóṣù tó ń bọ̀ yìí. So in an economy where there is a lot of inflation like that, you won't be having money is not going to be effectively used as a store of value. Because the value is store of value worth of 1 million. By the time you bring the money out, you can't buy something worth of 1 million again until maybe things are better in the economy. So those are like the two things inflation affects, the two forms of money that inflation is seriously affecting. Okay, then continue from there. It says okay, let us just read the first paragraph. Inflation is defined as a continuous and general rise in the price level due to a number of factors, namely the volume of money in circulation, unity demand pool, then the productive capacity of the economy, unity cost push. All right, imported commodities, the imported inflation, if goods or services are from an importing country suffering from chronic inflation, then high cost of production, is cost push, and so on and so forth. However, inflation affects price level, but the price level are measured in monetary terms. Hence, the link between inflation and money. Now, inflation affects two major functions of money, namely standard for deferred payment and the store of value, as explained earlier in this module, that made it possible for someone to work today and receive payments in the future date, any method of deferred payment, or to sell today and receive payments for goods in the future date. But with inflation, money loses its value, meaning that what an individual effort worth as at the date the work was done or goods were sold is not the same with what the payment the individual eventually received at the future date. So also, money is a store of value, that is selling a property that is not needed at a particular time and keeping the worth. So ilẹ̀ yìí bẹ́ẹ̀ kọ́ sí ẹ̀rí customer nísìnyí ẹ̀jẹ̀ ń talẹ̀ ẹ̀jà rí because tábà ní ká tà lọ́jọ́ iwájú sí a lè má ti tètè rí ẹni tó máa rà ẹ̀jẹ̀ talẹ̀ ní 2 million save owó yín pamọ́. So at the end tẹ́ bá rí pé okay o ní later ní future tàbí next year ẹ fẹ́ ná 2 million yẹn 2 million tẹ́ ẹ ná gan ó lè má ra ilẹ̀ yẹn gan padà, like that particular land you did not even buy it again because a ti gbówó lé lórí because money has lost value. So you may be needing more than 2 million to even get that land back. Or if you want to buy something else, to man worth 2 million in the past, you may not be able to get at that time again. So also money serve as a whatever. In that wise, money has served as store of value. However, during inflation, such value will be eroded. Therefore, it is obvious that inflation affects the value of money through the price system, a system in which the value of goods and services um, determined in the marketplace through the forces of demand and supply. So by implication, if the volume of money is greater than the available goods and services, if the volume of money is greater than the available goods and services, I said at the beginning that people having more money is not a problem. The problem is not having enough goods and services to supply for the things that people are demanding with that lot of money that they have. Okay, so the, by implication, if the volume of money is therefore is greater than the available goods and services, market prices rises unjustifiably. So àwọn èèyàn kan máa ṣáwó lé nǹkan tí wọ́n ń tà ní, which is what is happening in Nigeria, part of what is happening in Nigeria now. And money is going to be losing its purchasing power. The loss in the purchasing power of money is otherwise known as inflation. So the loss in the purchasing power is otherwise known as inflation. Nǹkan tí owó lè rà. So once tí nǹkan tí owó lè rà bá ti ń dínkù tó ti ń dínkù, tí ń experience inflation nìyẹn. So therefore, inflation and money are linked through price of goods and services that are determined in the marketplace. So mi ò mọ̀ tẹ́ bá ní ìbéèrè because I think the remaining thing here, conclusion, tutor marked assignments, yeah, I think that's the remaining thing. Got that Solana náà nìyẹn. So it says establish the link between inflation and money in an economy. I don't know, can you answer the question? Should we answer these questions or we should go to the next unit? Carlos, next unit, Abi. Okay, that's good. So supply of money. So supply of money is just talking about how money is made available in an economy, right? So the supply of money refers to the stock of money, which is the total amount of money in the economy. The total amount of money in the economy. You're not paying the supply of money. And so the total amount of money in the economy is actually determined by the central bank. Like central bank, ló máa issue owó náà in the first place. So and but central bank ló máa print owó. Mi ò mọ̀ tẹ́ bá wà aware. Are you aware that it's not central bank that prints our currency? Money, are you aware? All right. Plus money within the banking system. So that is the formula for finding money supply. So, but then money circulation, ìyẹn tí wàá pín sí ọ̀nà méjì, currency and coins or something. So currency and coins. So let's just go through what is here. The concept of money supply or money stock. So it can be called money stock. It can be called volume of money. Refers to the total amounts of money in the economy for purposes of policy, various clinical. Okay. So second paragraph, generally, so we now have things that we call narrow money and broad money. Narrow money. So I want to M1, M2. That's if we define one. So that is what is saying in the first paragraph, that for the purpose of policy, various definitions of variants of money supply are adopted in every economy, and these vary from one country to another. So I need M1, I need M2. I think we have M3. I need to see each of them túmọ̀ sí. So the second paragraph says that generally the narrow money definitions refers mainly to the money used as medium of exchange. So which is C plus DD. M1 is the narrow money. C is money in circulation. That was okay, money in circulation. Owó tó wà lọ́wọ́ yín, owó tó wà lọ́wọ́ mi. So definitely there are money outside the banking system. Owó tó wà lápò wa tí ó ṣáà sí ní bank, òun náà pè ní currency in circulation. So it is otherwise known, it's otherwise referred to as this should not be based money. I don't think this should be based money. Well, since they wrote based money, we're fine. But I mean, we are sure. So while the broad money While the broad money or broad definitions include money used as both medium of exchange and store of value. So they, yeah, I can hear you. Uh, that DD should be money in bank in the, within the bank, money in the banking system. It should be currency in circulation plus money in the banking system. So, but let's continue to be sure of what they are trying to say. Only M1 implies narrow money, which is C, and then it's otherwise referred to as, while the broad money or broad definitions include money being used as both medium of exchange and clinical. That is M2 is equal to M1 plus SD plus SD and TD means savings deposit and time deposit. Well, mention on DD, what is DD, Jambi by. So like even I don't know. I don't know. So I will just leave it that narrow money is just limited to the money circulation. So because they didn't define DD, and if they came back to say that broad money is money in circulation plus saving deposits and time deposit. You do saving deposit lówó téèyàn fi pamọ́ sí bank. So tó bá ti define ìyẹn sí under broad money, then definitely it's not under narrow money. So broad money is narrow money plus savings deposits and time deposit. Broad money is going to be equal to narrow money, which is M1 plus savings deposits and time deposit. Um, I don't even know time deposits to be honest, but let's just check. Let's just check. Okay. Oh, okay. Owó is even simple. Owó tẹ́ fi pamọ́ sí bank tó ń earn interest rate bí ó tẹ́ fi sínú fixed deposit account. Yeah. So nǹkan táwọn pè ní time deposit ni, so it's not even a difficult thing. So kí ló ń pè savings deposit, owó tẹ́ kàn save bí gbogbo owó tó bá ní savings account ní gbogbo wa, ìyẹn ni savings deposit. And time deposit, the time part of it is because it is subject to a particular period of time. Ẹ fi pamọ́ sí bank ni for a set period of time. So money na fixed deposit account and all of that. So ìyẹn ni wọ́n pè ní. But then tẹ́ bá wò broadly speaking, àti savings deposit o àti time deposit o, they are all money within the banking system. Because inú bank lẹ fi wọ́n lẹ̀ sí. So at the end of the day, I can try to like make things simple and simple. At the end of the day, money supply is still equal to money in circulation, which is the currency in circulation plus the coins in circulation plus money within the banking system. So money within the banking system làwọn wá gé sí méjì tó wá pè ní pé ìkan jẹ́ savings deposit o, owó tẹ́ kàn save tẹ́ withdraw at will, and the other part is the time deposit, the money that you are putting into an account to earn interest for a particular period of time. Kẹ́tẹ́ ṣe wá yọ kúrò. So I hope it's clear to that point. So in every okay, yeah, and broad money, yes. Narrow money, narrow money is just money in circulation. Just money in circulation. Then broad money is now equal to narrow money plus money within the banking system. Uh-huh. Oh, all right, all right. All right. So money within the banking system, bá ṣe sọ lọ́wọ́ pín sí méjì. Ó pè kan ní savings deposit, ó pè kan ní time deposit. So broad money at the end of the day is now narrow money plus time deposit plus savings deposit, where time deposit and savings deposit are both equal to or are equal to the money within the banking system. So like just maths, all you substitutes and whatever. So in every country, the central bank always states which definitions of money it is adopting at any particular time and for which purpose. The quantity of money in an economy has direct effect on the price level and therefore on the value of money. A ti ṣàlàyé lè tẹ́lẹ̀ pé tó bá ti pọ̀ jù ní economy ju service goods and service lọ, ó máa affect the price level, ó máa jẹ́ kí price level lọ òkè. Hence, to promote price stability and economic growth, the total money supply is subject to government control through the central bank in every modern economy. So government ló máa ń padà make sure pé owó ò pọ̀ jù ní economy ju nǹkan táwọn businesses dey provide lọ. Ibi tó bá dẹ̀ ti kéré, sometimes a máa experience deflation, which is the other part of inflation, deflation. So if inflation is the general increase in the price level, then deflation is the general decrease in the price level. So under deflation, owó máa ń níyì sí. So it's just like the reverse of inflation. Inflation, owó máa ń lose value, but deflation, owó máa ń níyì sí. And the reason with that ni pé àwọn èèyàn gan ra bó ṣe máa ń ra nǹkan tẹ́lẹ̀. So if you are not buying things and businesses are supplying things for people to buy, táwọn èèyàn dẹ̀ rà, but táwọn businesses is supplying, they would have to sell them at lower prices to encourage people to buy them torí àwọn èèyàn tiẹ̀ náwó in the first place. So the government bá rí pa deflation látún express in the economy, so they try to like increase the money supply through the CBN. And when they see that, okay, there's too much money in the economy, they try to decrease the money supply. So the government through the CBN tries to ensure that, okay, there is just enough money in, there's just enough money supply to ensure that the price level in the economy is stable. Mi mọ̀ tó bá yé ń débẹ̀ yẹn mà. Okay, so kí wá ní àwọn determinants of the supply of money, kí ló máa ń lead sí kówó máa pọ̀ ní economy, kówó máa kéré sí? So what are those things? Number one is the required reserve ratio. The required reserve ratio ní number one bí wáyé. And kí ni ìtumọ̀ reserve ratio? Reserve ratio, maybe I should put it in the chat box. Reserve ratio is the amount. Reserve ratio is the ratio, is the ratio that determines the amount of bank deposits that must be kept with the central bank. Reserve ratio is the ratio that determines the amount of commercial banks deposits that must be kept with the central bank. So gbogbo àwọn commercial banks yẹn ni wọ́n ní reserve ratio. So mo ṣe sọ reserve ratio is just the percentage, only ratio. So ratio is the percentage tó máa determine, okay, nínú gbogbo owó táwọn customers ń save sínú bank, èló nínú ẹ̀ ló ń lọ sí ọ̀dọ̀ central bank. Because one of the functions of central bank, I think it's also part of this course, where I think we have functions of central bank. Central bank is the one, and I also told you yesterday that central bank's major role is to ensure price stability. That's their major role, to ensure price stability. So some of the ways that they achieve that is like regulate the amount of money supply. So ibi tó bá ti pọ̀ jù wọ́n máa reduce ẹ̀, tó bá pọ̀ epo kéré jù wọ́n máa increase ẹ̀. So àwọn mechanisms wo ni wọ́n fi ń achieve àwọn kíní yẹn? So ìkànnì ní reserve ratio. Now these things can also be called instruments used by central banks to. Okay, all right. Okay, all right. So reserve ratio determines the okay, I was trying to explain that time. Okay, one of that these things that only CCB, what I think that determine money supply, they could also be called instruments used by central banks to regulate commercial banks. So I want you to also note that instruments used, they can also be called reserve ratio. They can also be called instruments used by the central banks to regulate money supply / commercial banks activities. Regulates money supply / commercial banks activities. So all you can regulate or control. So the bar anything along this line is still the same thing. So how does it work? In Nigeria, yes, 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 yes. So I want to show you an image. Okay, màá send kankan sí yín ní I send image kan sí yín ní WhatsApp. Okay, or should we use this one? Ìgbà wo náà ṣe lè? I think this is the current one. I send image kan sí yín ní WhatsApp. So we'll speak on that image. Yes, it's all right. So mo ti send there ó ti wọlé. Let's continue with our meeting. So ẹ ń gbọ́ mi báyìí sí àbí? Mo ní mo ti send the image kan sí ní WhatsApp, so we'll talk using that image. Ṣé ti rí image? Okay, okay, okay. All right. So according to that image, CRR, only cash reserve ratio, òun là ń sọ̀rọ̀ lé lórí báyìí, the cash reserve ratio. So in Nigeria, ní March 26, 2004, Monetary Policy Committee tí wọ́n meet, ẹ lè meet ara yín. Monetary Policy Committee tí wọ́n meet. So they made the CRR, the cash reserve ratio, 45%. So kí ni ìtumọ̀ 45%? So ó mean pé tí èèyàn bá mú 100,000 for example wá sí ìkan náà commercial banks, bí ẹ mú wá sí Zenith, no, ó dà pé máa ń lo Zenith jù, ká sọ pé a mú wá sí Stanbic IBTC, ẹ wá sí ìbẹ̀ sí Stanbic IBTC 100,000. Now, since the cash reserve ratio is 45%, then that means 45% of 100,000 must be saved with the central bank immediately. Immediately. So 45% of 100,000 is 45,000. So nínú 100,000 45,000 máa lọ sọ́dọ̀ central bank. So wáyé pé 55,000 ló máa kù fún commercial bank láti fi ṣiṣẹ́. Ẹ dẹ̀ mọ̀ pé ọ̀dọ̀ commercial banks náà ni àwọn èèyàn ti máa ń gba loan, àwọn investors máa ń gba loan. So tá a bá rí investor tó fẹ́ gba loan 100,000 kò lè rí 100,000 gbà nítorí pé 45,000 ti wà saved pẹ̀lú commercial banks, pẹ̀lú central banks. So the cash reserve ratio is the ratio that determines the amount of customer deposits with the commercial banks that must be saved with the central bank. So ní time inflation, kí wọ́n ní central bank máa ń ṣe? Central bank bá realize pé inflation tá experience is demand pull, nítorí pé àwọn èèyàn ní owó, àwọn èèyàn fẹ́ máa ná owó gidi, right? On inflation if you wà. So the central bank will raise the cash reserve ratio. Nǹkan tí Cardoso ti ń ṣe lágbà tó ti dé náà nìyẹn. It was not 45% when it came. I think it was about 30%. Wọ́n gbé sókè ló fà ní 45% nísìn. So they will raise the cash reserve ratio. So tó bá gbé 45% tó wà ń sìn, wọ́n sì wá rí pé àwọn èèyàn tó ṣì ní owó tó ṣì ń ná, wọ́n lè raise ẹ̀ sí 50% àbí 60%. So which means that more of the commercial bank's money will be getting saved with the central bank. So commercial banks ò wá ní enough money like láti fi ṣe òwò bó ti ṣe fi ń ṣe òwò tẹ́lẹ̀tẹ́lẹ̀. So owó dẹ̀ ní commercial bank ń ṣe. Commercial banks are intermediaries between savers of money and borrowers of money. Àárín ni wọ́n wà. So báwa kan ṣe ń lọ bank tẹ́ pé owó làkàn lọ save sí bank. Àwọn kan wà tó ń lọ sí bank tẹ́ pé wọ́n lọ withdraw ní tiwọn ni, wọ́n lọ cash out ní tiwọn ni. Right? So in this kí ni wọ́n pè? So in this case, central bank controls inflation by increasing the cash reserve ratio. But if they realize that there is no inflation, maybe a deflation will also experience because people are not really spending, so they will reduce the reserve ratio. So about to reduce the reserve ratio, our commercial banks saying they will have more money to work with because they now have to save less with the central bank. So what they were normally lend So tó bá ní pé how do commercial banks create money? They create money through the loans that they give. How does the central bank create money? Central bank can create money by issuing new currency. So I want you to note that central banks create money by issuing new currency. Àwọn kan máa da new currency síta bí central bank ṣe ń create owó nìyẹn. But báwo ni commercial banks ṣe ń create owó? Àwọn create owó by giving out loans. So when you come to them, you come and borrow loan. Tó bá ti yá loan, wọ́n máa charge any interest rate. Currency, they issue currency. Àwọn ló máa jẹ́ kí currency wà available, àwọn kọ́ ló ń print ẹ̀. Àwọn kọ́ ló ń print ẹ̀, but àwọn ló máa kọ́ wà available. So that's what we call the issuance of currency. They issue currency. Commercial banks don't issue currency. GTO lè máa issue currency. Àbí Stanbic IBTC máa issue currency. So if you are asked, how do commercial banks create money? They create money, commercial bank through the giving out of loans to investors. But central banks create money through the issuance of new currency. Àwọn máa issue owó tí wọ́n ní. All right. So now, proceeding from there. So for commercial banks, tẹ́ bá deposit owó bí ẹ fọ́ sí fixed deposit account. Ó lè sọ pé wọ́n máa fi ní 10% interest rate. Now tẹ́ bá lẹ́nìkan tó fẹ́ yá owó, so ó lè charge ẹni 25% interest rate. So tẹ́ni yẹn bá dá owó yẹn padà, wọ́n máa fún ẹ lówó tí àti 10% orí ẹ̀, àwọn dẹ̀ máa jèrè 15% profit tàwọn nìyẹn. So ibi tí commercial banks ń rí owó jù, or one of their biggest sources of income òun nìyẹn. So it is through this giving out of loans, acting as financial intermediaries. Financial intermediary mean pé they are middlemen that take money from those who are saving the money and they lend it out. They lend the money out to those who are going to invest the money into businesses and whatever. So that's the way the cash reserve ratio works. To control inflation, it is raised. To control deflation, the cash reserve ratio is reduced. And like we are saying, currently in Nigeria, cash reserve ratio is 45%. Now the second thing, the one in sliding, I think that one is liquidity ratio. So liquidity ratio, okay, sorry, not liquidity ratio. Liquidity ratio wa. Liquidity ratio B. But air cash liquidity ratio. Yeah, bank reserves. Yeah, air cash liquidity ratio. So for liquidity ratio, this is the ratio of money that must be kept with commercial banks themselves. So I only will keep it with central bank. So it is the ratio of the bank deposits that must be kept with the commercial banks to mitigate against future crises. To mitigate against future crises. So reason that that be precautionary demand for money in whatever. So our banks now need T1. So like there might be a bank run. Èèyàn sáré lórí bank òun ìtumọ̀ bank run. And what does bank run mean? Bank run means that it's a situation where a lot of customers are trying to withdraw their money simultaneously. A lot of customers. I think we've even explained this thing before. A ti sọ̀rọ̀ lórí Wigwe nígbà tí Wigwe kún gbà yẹn táwọn èèyàn bá ní trust nínú Access Bank wọ́n kàn wá lọ máa withdraw ni. So liquidity ratio is the ratio of bank deposit bank náà gbọ́dọ̀ keep pẹ̀lú ara títí wọn to mitigate against things like that. So kò gbọ́dọ̀ sọ̀rọ̀ pé ẹ dé di ATM ẹ fẹ́ cash out ẹ rówó yín cash out tẹ̀dẹ̀ lówó nínú account ó máa dé run tó. So it is part of this liquidity ratio that would give room for money that people are able to continuously withdraw from banks. So liquidity ratio ní Nigeria, tá bá tún padà sínú image tí mo send yín ní WhatsApp yẹn, liquidity ratio in Nigeria is 30%. 30%. So for 30%, ó mean pé lẹ́yìn 45,000 30 fún central bank nínú 100,000, 30,000 tún gbọ́dọ̀ máa wà lọ́wọ́ yín all the time. Anytime anybody brings 100,000 to you, the bank, you must also save 30,000 naira with you at all times. So nínú 100,000, èló ló wá kù? Ẹ ti save 45 sí ọwọ́ central bank. And then the 30, ó kù 25, ó kù 25,000. So 25,000 lè wá yá investors. So that's the amount of money that you can lend to investors, right? So simply because Nigeria is trying to take away money away from the economy. Òun ló ṣe ń raise gbogbo àwọn kíní. So if they want commercial banks to be able to lend out more money to investors, they will lower this rates. Ó lè dá cash reserve ratio kọ́ dá padà sí àbí 20%. Then kọ́ dẹ̀ dá liquidity ratio ó lè dá ìpadà sí 10%. So tó bá tí cash reserve ratio bá jẹ́ 20%, á pé 20,000 ló máa lọ sọ́dọ̀ central bank nínú 100,000, owó máa kù 80. Liquidity ratio tó bá jẹ́ 10%, 10,000 náà máa wà ní ọwọ́ commercial banks all the time. So they now have 70,000 to lend out to investors, right? Instead of 25,000 to only lend out for every 100,000 that is deposited with them. So in that case, they are trying to make more money available in the economy through the lowering of this reserve, ratios. So this is real. Because when it is real, like what in Nigeria, so at least you can see the dates. Monetary policy, I think MPC meeting now, monetary policy committee meeting. Don't she need to be a meta, So then, so you'll be understanding the whole thing better. Think about your internet, so I understand it better. Now for the first one, to one B, till there's in the slide, the monetary policy rates. That's the first one before CRR and LR. So what does it mean? This is the leading interest rate in an economy. The leading interest rate in an economy, only monetary policy rates. The leading interest rates in an economy. So it is just so I think you would have to be when the recording is available, you will see all of these things that we are sending, because more critical about end learning become all of these things on my wipe off. Okay, okay. This is the leading interest rate in an economy. Leading or baseline interest rate in an economy. So nǹkan tẹ́lẹ̀ ń sọ ni pé once tí ọba ti fix a monetary policy rate, then that is like the least interest rate that must be charged on anything. Anything tó bá jọ mọ́ interest rate in the economy. So the monetary policy rate is going to be like the least. So iye bóyá bank fẹ́ yá yín lówó, the least you can lend out money is going to be the rate that we have here. It's going to be 24.75%. That's the least percentage that you can charge as a bank to lend out money. So nǹkan tí ó mean nìyẹn. And then by the time tí monetary policy rate bá committee tó bá increase monetary policy rate, nǹkan tí wọ́n try to sọ ni pé okay, because it is the leading interest rate in the economy, already increase it sí 30%. Tó bá increase it sí 30%, wọ́n communicate sí gbogbo economy pé you must now raise interest rates. So the value raise interest rate it may not be equal to around 30%. It can be more than 30%. But the message is that since you have raised the MPR, you must also raise the interest rate that you are charging on loans, etc. like that. So signal ni. So tó bá tún meet, tó bá reduce MPR. So to the signal as economic, okay, bring down interest rates. So it may not be bring down interest rates back to the same amount that that the MPR is. Only tí MPR bá fall sí 15%, and we can break interest rate náà padà sí bí 15% dandan. But ẹ ṣáà bring it down, like ṣáà lower it. Right, so that's the point. So lower it. So only 18%, only 20%, but shall lower. So it is a signal, it's an interest rate signal that sends a message to the economy on how other interest rates must behave. So nígbà tí tẹ́ bá wo eléyìí ni the one as at March 26, 2024. Tí máa lọ wá títí only kan, let me download this one and show you. I don't know, ẹ ṣe rí screen mi àbí? Okay, let me just download it. I think I always have to be in the meeting for you to see my screen. So let me I'm able to download new mumbo. Okay, go to download. Àti kọ́ àwọn ọmọ àti fi gbogbo àwọn kíni kan kọ́ àwọn ọmọ ní school gone already. So I'll send you another one. Shetty. So eléyìí as at February 27, as at February 27 ni eléyìí tó wà níbí. So ní February 27 rí pé NPR was 22.75 ní February 27. Eléyìí táwọn wó lẹ́ẹ̀kan ìyẹn March 26. So a month later wọ́n increase it by 2.75%. So nǹkan tó mì ní pé okay o, we want you to begin to charge more interest rate on loans. So that's what they're trying to let them know. We want you to charge more interest rate on loans. So, like again, it is an interest rate that signals to the economy on the direction of other interest rates. Sends a signal to the economy on direction of other interest rates. Like that's about that. So continue from there. Ká wá padà sí ètò wà ní math. At least àwọn ilé ìta ti kọ́ yín sìn. These are things that are real in Nigeria right now. So bá ṣe ń kọ́ ètò wà ní textbook, a máa kọ́ ètò ń ṣe náà nínú ìlú wa gangan, so everything can make sense. Now the level of bank reserves. The level of bank reserves is actually affected by our cash reserve ratio tá a sọ lẹ́ẹ̀kan àti liquidity ratio. Now bank reserves ìyẹn ni owó tó kù tí bank lè fi ṣiṣẹ́, òun ló ń pè ní bank reserves. So nínú gbogbo owó tí àwọn bank customers bá deposit sí commercial banks, right? They are deposits and they are also called reserves. Like the same thing ni wọ́n. So ẹni tó 100,000 naira wá, they are deposits of the customer and it is the reserve of the commercial bank. So by the time tí commercial bank bá wá san owó tó yẹ kó san fún kí ló ń pè fún central bank, okay, required reserve nìyẹn, cash reserve ratio. So it is a required reserve, what you must save with the central bank that is required of you. So by the time they bá ti yọ required reserve kúrò, eléyìí tó wá kù lọ́wọ́ yín ó jẹ́ à ń pè ní excess reserve. À ń pè ní excess reserve. So 25k tá a sọ lẹ́ẹ̀kan yẹn excess reserve nìyẹn. Ẹ ti yọ liquidity ratio, ẹ ti yọ no, not liquidity ratio, ẹ ti yọ kí ló ń porúkọ ẹ ti yọ cash reserve. The ratio is the one that determines the reserve. So it's your cash reserve of 45,000, call 100,000. 100,000 minus 45,000 is now the excess reserve. So what they are trying to say here is that the money supply is also affected by the amount of excess reserve. Like to me, even the way I'm looking at it now, your liquidity ratio, no. Because they are not going to lend us liquidity ratio. So I think it is just trying to make things very, very simple. You must shake it so normally whatever share exam or something, real liquidity ratio. Okay, so I saw the liquidity ratio. The cash reserve ratio is clinical. So they expect to just subtract your cash reserve from your total reserves. But like realistically speaking, I am thinking that there should be liquidity ratio should also be removed because based on its definition. So I'm thinking that the excess reserves should be reserve owó tí wọ́n fi pamọ́ sí bank minus cash reserve minus liquidity reserve. So nǹkan tó bá kù tẹ́lẹ̀ lend out síta òun ni excess reserve. So 25,000 tẹ́lẹ̀ lend out nínú 100,000 inú example wa òun ni excess reserve. So the amount of excess reserves also affects the amount of money in circulation. So níbi tí excess reserve jẹ́ 25,000, iye tí commercial bank lè lend out síta nìyẹn just 25,000. So kẹwàá fi gbé ìgbà tí excess reserve bá jẹ́ 70,000 ní ìgbà wo, is it between 70,000 and 25,000? In which of those circumstances would more money be available in the economy? Was it when commercial banks had 70,000 to lend out or when they had 25,000 to lend out? Exactly. So which is still ó sì link padà náà sí cash reserve tá a sọ látẹ̀kan pé for the commercial banks to be able to lend out more money, you must be able to like have a low cash reserve and a low liquidity reserve ratio. So gbogbo ẹ̀kọ́ link mọ́ra wọn ni. So number 1 and number 2 gbogbo ẹ̀ link mọ́ra wọn náà ni. Now then they mention something else. Ó ti kó àwọn kíní pọ̀ gan. But let's just read. It says the level of bank reserves is another determinant of the money supply. Commercial bank reserves consist of reserves on deposit, the central bank of the country, and it influences the reserves of commercial banks in order to determine supply of money. The commercial banks are required to hold reserves equal to a fixed percentage of both time and demand deposits. These are legal minimum required reserves. So required reserves are determined by the required reserves ratio and the level of deposit of a commercial bank. The higher the reserve ratio, the higher the required reserves to be kept by a bank, and vice versa. But it is the excess reserve, it is the excess reserve that is important to the determination of money supply. And excess reserves are the differences between the total reserves and the required reserves. About a minus. So a commercial bank advances loans, that is, they give out loans equal to their excess reserves, which are the important components of money supply. To determine the supply of money with commercial bank, the central bank influences its reserves by adopting open market operations or the discount rate policy. So mo wá fẹ́ ká ṣàlàyé open market operations because this is another instrument. Open market operations is another instrument by which the central bank regulates money supply. So open market operations can define this. Mi mo ṣe ti fi ń bá ròyìn padà. Okay. So open market operations refers to the sale and purchase. Open market operations refer to the sale and purchase of government securities, government financial securities. Operations refers to the sale and purchase of government financial securities. By the central bank. Ẹ lè fún wọn padà. Ẹ ní pẹ́sù tẹ̀lé fún wọn ni. Ó ti dáa. Anyway, mo ti save ẹ̀ ṣá. You'll be seeing it also when you are watching the videos. So open market operations refers to the sale and purchase of government financial securities by the central bank ló máa ń tà on behalf of the government. So e.g. bonds, treasury bills, treasury certificates, etc. These are the financial securities. I think we spoke about bond nígbà kan, any pension bond or something like that. Pé wọ́n fi pension ra bond bí nǹkan. I think we mentioned it. So níbí báyìí, if the central bank, okay. So if the central bank wants money to be in circulation, they will buy bonds from people. So àwọn tó ti ra bonds lọ́wọ́ tẹ́lẹ̀ àti treasury bills àti nǹkan kan tí wọ́n ti rà lọ́wọ́ tẹ́lẹ̀, central bank máa wá rà á padà lọ́wọ́. So bóyá ẹ̀yin ra bond bí 1 million worth of bond, èmi ra bond bí 600,000 worth of bond. So central bank will now buy those bonds. And ẹ̀dẹ̀ mọ̀ pé tó bá ti ra bond, wọ́n fi owó sí wa lọ́wọ́ nìyẹn. You understand? Ẹni tó bá ra nǹkan gbọ́dọ̀ sanwó náà. So when they buy those financial securities, they put money into our hands because they have to pay us. So by paying us, they are increasing the money supply, they are increasing money in circulation. So owó táwọn èèyàn lè ná sí, ó ti increase since you've gotten additional source of income. And the other way around, tí government bá fẹ́ control inflation, bí owó ti pọ̀jù ní economy, they will sell bonds. The Nigerian government is also doing that, like currently, or as at some time ago, tí mo gbọ́, they are also selling bonds. So once to the international market actually, because I need the dollars. So wọ́n ta àwọn bond yẹn fún àwọn tó bá lè fi dollars rà láti ìlú òyìnbó. So and then ẹni tẹ́ bá dẹ̀ ní dollars náà ní Nigeria tẹ́lẹ̀ rà, even naira. So the thing that they are trying to do is that by the time they sell securities, you will buy them. Tẹ́yìn bá dẹ̀ ń rà mú, ẹ̀yin sanwó, ẹ̀yin fi owó sí àpò ìjọba nìyẹn. Like ẹ̀yin fi owó sí àpò ìjọba through the purchase of those bonds. Tẹ́ bá ra bond worth of 800,000 láti fi gba 1 million ní next year. That means you have to pay 800,000 naira. So my debit in 800,000 naira. So which means that you can't spend as much as you used to spend before on other things because you are 800,000 naira short. So to control inflation, the government sells securities in the open market. They sell securities. So that takes money away from the economy. And to put money in circulation, the government buys securities. So I want you to understand that. So then finishing that, we now go to the discount rate. Discount is another tool. Tomalo. So what's the discount rate about? Discount rate is the interest rate. Let me write it. Discount rate. Let's go back for you. Discount rate is the interest rate that central banks, that the central bank charges commercial banks when they come to obtain loans. So sometimes if central bank, one other thing I should know about central bank is that it is a lender of last resort. Central bank is the lender of last resort. So nǹkan tó mìíràn ni pé tẹ́ bá ti lọ sókè sódò, not as an individual o, a lọ sókè sódò as a business or maybe as a government tí wọ́n rówó yá wọ́n máa lọ jáwọ́ lọ́wọ́ central bank. Central bank is like the last place. Central bank does not deal with private individuals. They don't deal with private individuals. They deal with governments and banks. So they are bankers' bank. The central bank is a bankers. They are banks bank. They are banks bank. They are also this. They are also the government bank. So central bank, they are banks bank. They are also the government bank. So tí commercial banks bá ti lọ sókè tó tó fẹ́ yáwó bóyá lọ́wọ́ ara wọn, UBA lè fẹ́ yáwó lọ́wọ́ Union Bank, Union Bank lè fẹ́ yáwó lọ́wọ́ First Bank. So possible to do one thing or the other. But tí wọ́n bá rówó yá, so the last place that they can go to is the central bank. So interest rate, the central bank máa ń charge wọn, òun náà pè ní discount rate. So discount rate is the interest that the central bank will now charge commercial banks. Interest the central bank in charge lórí owó tó ń yá commercial bank òun ni discount rate. Kàkà kó pè ní interest rate tó wá fún olórúkọ míì a discount rate. So tí wọ́n bá fẹ́ kí money supply increase, kí ló yẹ kí central bank ṣe sí discount rate yẹn? Ṣé kó increase ẹ̀ àbí kó lower ẹ̀? Tó bá fẹ́ kí owó púpọ̀ wà ní economy, ṣé kí central bank increase the discount rate ni àbí kí wọ́n lower ẹ̀? Kó lower ẹ̀. Exactly. Then tí wọ́n fẹ́ control inflation tó dẹ̀ pé discount rate ló fẹ́ lò, so kí ló yẹ kó ṣe sí discount rate? Increase it. So like that's about that. So kì í ṣe àwọn kan tó le bẹ́ẹ̀. So one just has to like pay attention to how all of these things are working. So then moving away from that, ká wá wọ number 3. So wọ́n ti kó nǹkan tó pọ̀ sí number 2 and they ti break it down kékèké. So number 3, public desire to hold currency and deposits. So ilé náà máa affect money supply. Tá bá wà ní economy tó yẹ pé àwọn èèyàn really fẹ́ owó dání. The Nigerian economy now is highly a cash-based economy. Àwọn èèyàn ṣì wà nínú ìlú ìtẹ́ pé tẹ́ bá ní kẹ́ ṣe transfer fún ọmọ ní rárá, cash ẹ̀ làwọn fẹ́. So if people want to deal with cash a lot, they can also affect money supply, because the way that the central bank can actually control money supply is to have most of the money within the banking system. Ṣé understand? So nǹkan tí àwọn Buhari àti Emefiele nígbà yẹn tó fi ṣe naira redesign kìnnìkan nìyẹn, because they wanted most of Nigeria's currency to be kept in the banking system. But kíní yẹn padà fail. Ó bọ́ sí àsìkò election. Àwọn politician dẹ̀ need owó láti fi rig, láti fi bribe. Owó tí máa fi rig election mi lè transfer ẹ̀ now. Ṣé mo máa transfer owó tí máa fi rig election ni? Because ẹ máa lè trace ẹ̀. So cash ló pay. Then there are these business people tí wọ́n fẹ́ lọ ra nǹkan níta. Bana ẹ jẹ́ sáré ṣe transfer. Èmi ò gba transfer o. Èmi ò gba transfer o. Cash mo fẹ́ o. So if you have an economy where people want to deal with cash more, it is not very easy for it to kind of control the money supply. So that was what the central bank was pushing. They were trying to like get the money into the banking system. So ojú wọn lè ká, right? But then this is also, let us just read what they have here. The public desire to hold currency and deposit. People's desire to hold currency or cash relative to deposits in commercial banks also determines the money supply. If people are in the habit of keeping less in cash and more in deposit with banks, it really means I don't like carrying cash around. Iye ìwọ̀nba tí máa need náà ni mo like máa dì mú. Owó mọ́tò àti bóyá owó small things. Now, if people are willing to like keep less cash and more money within the banks, the money supply will be large. This is because commercial banks can create more money with larger deposits. So if people are more interested in keeping deposits with commercial banks, and when commercial banks might create owó náà from deposit náà tó bá ti yọ cash reserve gbogbo ẹ̀ inú ẹ̀ náà lọ sí máa ní excess reserve. So tí deposit àwọn èèyàn bá ń pọ̀ nínú commercial banks, excess reserve wọn náà máa pọ̀. Ẹ ti understand bẹ́ẹ̀ yẹn? So it has a positive implication on the amount of money that commercial banks can create. But if people are willing to hold cash more than the money that they keep within the banking system, then commercial banks will not be able to create so much money from having fewer deposits to work with. So nǹkan tó lè sọ náà ni pé how people's preference for either cash or bank deposits can affect the money supply. Now, on high-powered money. So high-powered money is the sum of the commercial bank reserves and currency notes held by the public. So high-powered money is the base for the expansion of bank deposits and creation of money. Kinikon. Well, this is still talking about. I think this is just an unnecessary point because as you explain, the deposit here affects, and as you explain excess reserves. So high-powered money is not bringing the two together. So I just think that it is an extra point since we've already spoken about, the components of high-powered money in the first place. But then high-powered money is basically bank reserves plus currency in circulation, which is the same thing as money supply. Taba will know. Same thing as money supply. Now, other factors. So I don't think high-powered money should be a factor that one should be including. So other factors also now include money supply is a function of not only of the high-powered money determined by monetary authorities, but of interest rates, income, and other factors. These factors change the proportion of money balances that the public hold as cash. Changes in business activity can change the behavior of banks and the public and thus affect the money supply. So irú àwọn ètò wa mention bí báyìí say they are not monetary policy tools again. Changes in business environment, CBN kọ́ ló wà in charge of that one, government ló wà in charge of that one. Ṣé you understand ma? Hello ma, ṣé wà ń bẹ̀? Àbí mi nìkan mo kò meeting. So to enable a good business environment, it is not the function of the central bank to do that one. Government ló máa ensure pé infrastructural facilities wà tí business lè lò. Àwọn ló máa ensure pé security wà. Àwọn ló máa ensure pé property rights wà. So these ones are not. Ẹ̀wọ̀n kí mo sọ nígbà pé when we started that tools or instruments used by central banks to regulate commercial banks. So eléyìí tí wọ́n sọ mí báyìí sì kò sí lára ẹ̀ o. Kò sí lára nǹkan tí central bank ń lò. So these are just things that the government can do, to have impact on the money supply. Then the velocity of money. Velocity of money is referring to how quickly money changes hands in an economy. The velocity of money refers to how quickly money changes hands. Money changes hands in an economy. So kí ni ìtumọ̀ ilé? Tó bá wà lọ́wọ́ yín, tẹ́ wá sanwó fún mi fún service mi, the velocity of money is 1 because money has only changed hands once. It was with you. Ọwọ́ yín ló wà tẹ́lẹ̀ tẹ́lẹ̀. So you now gave it to me. You used to pay for a service. So it has changed hands only one time. So the velocity of money in that case is just equal to 1. But tẹ́ bá fún mi ní owó, tèmi náà fún ẹlòmíì. Bó ti jẹ́ pé àwa mẹ́ta la wà nínú exchange yẹn, you were the first person, you gave it to me. So it changed hands once. Then èmi fẹ́ ẹlòmíì, it changes hands twice. So velocity of money is equal to 2. So velocity of money is just talking about how money changes hands in an economy. So how does it affect money supply? So we are looking at it that the velocity of money in circulation also affects the money supply. If the velocity of money in circulation increases, the bank credit may fall even after a decrease in the money supply. The bank has little control over the velocity of money, which may adversely affect bank credit. Bank credit is just talking about the amount of money within the banking system. So tó bá yẹ pé àwọn èèyàn for banks to be able to like have excess reserve tí wọ́n lè fún investors, it is because they are savers of money. Àwọn tó save owó for a long period of time. Ẹ kàn máa wá ẹ kì í fowó sínú bank deposit for 2 years. But tí ó bá sáwọn tó ń save owó fún like 2 years, báwo ni bank ṣe fẹ́ rí owó yá àwọn investors tó need owó fún like 2 years? Because owó tẹ̀yìn save tẹ́lẹ̀ mú kúrò nínú ẹ̀. Because tẹ́ bá ti fowó sínú fixed deposit account, you can't withdraw it. Owó tẹ́ save tẹ́lẹ̀ withdraw, owó ló máa sáré yá bẹ́ẹ̀ ẹ̀yin máa gbá in 2 years time. Wọ́n máa mú owó yẹn máa sáré yá investors tó máa dá padà ní bí 1 year time or after 1 year 6 months. So by the time tí yẹn bá ti dá padà, wọ́n máa rí owó tí yín san àti interest tó yẹ kó fún yín, then àwọn náà máa cash out to interest tàwọn. But if people are not saving money for as long as 2 years, tó dẹ̀ pé like the velocity of money is high, owó yín láàrin bí 2 days ẹ ti send ẹ sẹ́lómi, ẹni ẹ náà ti send ẹ, so owó yẹn kàn lọ káàkiri bẹ́ẹ̀. So it's not as if people are really like leaving their money to stay for a long period of time. Tí bank lè sọ pé okay o, kẹ́ni tó béèrè owó yìí ó máa tó ìgbà báyìí, so ẹ jẹ́ ká sáré yáyàn. So tí ò sí irú nǹkan bẹ́ẹ̀ yẹn, then money supply too is going to be like limited. But it affects the amount of money that the commercial banks will be able to create adversely. Like you understand? So money needs to stay with commercial banks for a significant amount of time for them to be able to lend that money out, for them to be able to create more money through it. So if you are not leaving the money there for a long period of time, then or for a reasonable amount of time, then they can't use that money to create anything. So the more the velocity of money, the less the commercial bank's ability to create more money, and then the less will be the money supply, or the less will be the future money supply. Like if you like something, the less will be the future money supply. So after that, share gets part like, can we move on? Can we see demand for money? I just know demand for money. Tell it. So can feel demand for money, transactional, whatever. Spoken about them before. Then the quantity theory of money. This is actually a theory that tries to explain the fluctuation in the price level in an economy. Like it's a theory that is trying to explain why there's inflation. And to postulate the theory is called Professor Ivan Fisher. So the theory suggests the existence of a direct relationship between money supply and the average price level in the macroeconomy. Specifically, the quantity theory of money states that the price level is strictly proportional to money supply. Now, kí ló ń try àti sọ ni pé tí price level tí money supply bá increase by 100%, price level náà máa increase by 100%. So nǹkan tó mean by direct relationship nìyẹn, or proportional relationship. So if the money supply should increase by 10%, then we should be expecting inflation of 10%. So that's what it's trying to say. A change in price level of 10%, that's what we should be expecting. So Professor Ivan Fisher ni ó postulate the theory yìí. So all that is spell òun ló wà níbi Ivan Fisher ìmọ̀tẹ́ bá ti rí. Kò copy o, but òun mo ṣáà ti ń try àti enlarge láàrin bíbá yìí. IRVIN, then Fisher. I don't think the year is important. So it is also known as the equation of exchange. The quantity theory of money is also known as the equation of exchange. So it is a theory that tries to explain the reason for changing price level in an economy. And it links that to changes in money supply. It links that directly to changes in money supply. So nínú bíbá yẹn sì M òun ni money stock or money supply. M is the money stock or money supply. V is the velocity of money, the number of times that money is changing hands. P is price or price level, average price level. Then Q is the quantity of goods and services produced in an economy. So Q is also known as the real national output. So what's he mentioned as CB? M is total money supply or total stock of money. Or maybe high-powered money. In case like high-powered money, not facing the question. V is the velocity of money. P is the average price level. Then Q is the real national output. So what are the assumptions? The velocity of money circulation is fixed. That is, iye ìgbà tí owó ń change hands in the economy, ó wà fixed. So kò sí nǹkan tó ń jẹ́ pé there is higher velocity of money or there is lower velocity of money. So that's number one. Number two, the real GNP is fixed in the short run. GNP is price times quantity. So let me say PQ. Q is just the quantity of goods and services produced in an economy. But PQ is the value of the goods and services produced in an economy. Once they want to multiply by price, so what time is the value, right? And other question, ẹ ti fèsì diminishing returns àbí? Ọkàn yóò sí níbàá mọ́. Okay. I'm recording it. So Q is the real national output. I was talking about PQ being the real GDP. So price level. The about to say price multiplied by quantity. So because the quantity here is the quantity of goods and services produced in the entire economy. So P times Q is going to give you the GDP. But in this case, what we need GNP, so no wala. And they say it is fixed in the short run. Now, money stock is M, then economy is at full employment. Where the actual GDP is equal to the potential GDP. So economy is at full employment. These are the basic assumptions. So how do you get the price level? Since you have the equation as MV equals PQ, just make P the center of the formula. Then you get this. Same as the V. You get that. So equation 2, which represents the quantity theory of money, is obtained by making P the subject of the relation equation 1. It follows, for example, that a 5% increase in money stock because the average price level in the economy to rise by 5%. We've said that before. Because the theory is saying that there is a direct relationship between the money supply and the price level. So if the money supply should rise or fall by a particular percentage, the price level would rise or fall by that same, percentage. Okay, then since both Q and V are fixed, so Q is assumed to be fixed, V is assumed to be fixed. So since that many values were fixed, BP bashing increase, BM bashing increase on the P shema increase, so that one is basic thing. So also equation 3 represents, do we need anything here? The major policy implication of the theory is that monetary policy of the restrictive type is most relevant for effective control of inflation. In other words, to curb problem of inflation effectively requires the reduction of money stock through the use of monetary policy instruments such as market operations, reserve requirements, and bank rates. So like I said, this theory just tries to let us know the causes of inflation.
Sorry.
Yeah.
Well, you are using the class. I'm sorry.
No, don't worry, I'll step up. So as I mentioned earlier, that the theory is just trying to explain the causes for inflation in the economy and how inflation can be controlled. So if there's an increase in money supply, inflation will. So for you to control inflation, you have to reduce the money supply. So if you reduce the money supply by a particular percentage, are you here too?
Yes.
Okay. The whole floor, right? So if the money supply is to change by a particular, the value reduces by a particular percentage, then we expect that inflation too is going to fall by that same percentage. Ma, wọ́n lo àwọn kan lo all rent a school building space wọ́n fẹ́ ṣe program but I'll move to another place that is not being used. School wa ní classroom tó pọ̀, so it's not a problem. Yeah. So what then are the determinants of the demand for money? So we also spoken about this one not tẹ́lẹ̀ now. What will affect your demand for money or your demand of money? So your level of income yìí bá pọ̀ to affect your demand for money. Price level níbi tí owó kékeré ò sí owó ńlá ò ti lè ṣe owó ńlá ń ṣe nǹkan kékeré, then that means you will need to have a lot of money to keep doing what you are supposed to do. That's how price level affects. Then interest rate. If interest rate is high, then your demand for money is likely going to be low. Because interest rate is high, it is better for you to save your money in the bank and enjoy the interest rates provided by the bank than for you to take the money and spend. Then return on financial assets. Àwọn ilé ìtẹ́ bá rí pé bá ṣe àti sọ́rí náà tẹ́lẹ̀ tẹ́ bá rí pé the alternative to investing to keeping your money in the bank, eléyìí sì ń sọ̀rọ̀ lórí speculative demand for money already, which is the demand for money to take advantage of business opportunities. So when you see that investing your money in other financial instruments or other assets will give you more reward than to keep your money in the bank, your demand for money will be high. Because ẹ máa fẹ́ tètè gba owó yín ẹ cash out owó yín kẹ́ lọ fi sínú assets tó máa fún yín ní more reward. Then government policy, only bí government policy náà ṣe máa affect money demand. Tí government bá ṣá tax léyàn bí a ti sọ lórí ilé náà rí, so if the tax is more than what it used to be, then now you are going to be cautious. The amount of money that you can even spend is going to be lower than what you could spend before the tax was imposed or before the tax was increased. Then the time lag between the time income is received and expenditure takes place also determines the transaction balance, which is point number 6. Income and expenditure are not done simultaneously. Therefore, the level of individual transaction influences the amount of cash balance held at a particular time. So this one is talking about length. So are you the kind of person that you tend to have money every day? Or you are the kind of person bí a ń ṣe business every day or every week you are expressing cash flows, àwọn èèyàn sanwó láti ra ọjà yín, or maybe you are a civil servant, or maybe you are a worker in the private sector that you need to wait for 30 days to spend to receive a salary that you are going to spend in one day. So the time lag ìyẹn náà lọ sọ pé ìyẹn náà máa affect money balance, that is your demand for money. So tó bá jẹ́ tó máa receive tó máa pé every now and then ni owó máa ń wọ inú àkáǹtì because you are a business person, the amount of money balance that you will be keeping is going to be like different. So tẹ́yìn bá mọ̀ pé owó mi ṣì máa wọ àpò mi ní ọ̀la ń sìn, so what is the reason why I should be keeping cash today if I know I'm going to see cash tomorrow? So the one I saw today I could save it, or I could save all of it and not spend because I'm sure I'll get another one tomorrow. But someone that 30 days ni òun fi dúró láti fi rí owó, tó bá rí owó lẹ́nu ó ti mọ̀ pé tún ti lẹ́yìn 30 days, so I will save a significant part of the money to continue to spend, as the month is going kí ó tó di pé ó máa gba the next owó oṣù. That is what point 6 is talking about. So with that, we've come to the end of this particular unit. So commercial bank and credit creation activity òní a fẹ́ wọ́n sìn. So ṣáà ní ìbéèrè, ṣáà ní contribution. Okay. And then we have a commercial bank and credit creation activity. I've already explained this in the previous lesson. So commercial banking. What's a commercial bank? Like that's the first thing. So commercial banks are financial institutions. I want to call it financial institutions. So they are a type of financial institutions that save customer deposits, they save money for customers and other valuable assets, and also lend out money for investment purposes. So nǹkan tó jẹ́ kí commercial banks sí dá yàtọ̀ ni pé àwọn máa ń save owó fún customers. So àwọn yàtọ̀ insurance companies are also financial institutions, but they don't save. They provide insurance, but they don't accept customer deposits. So commercial banks accept customer deposits. Yeah. So they are financial institutions that accept customer deposits, keep valuables for customers, and also provide um, loans to business people for the purposes of investment. So let's read what we have here. So commercial banks are the key institutional mechanism through which money performs its numerous functions in any economy. It is therefore important to examine the specific story. So commercial banks are also known as fractional banking system. No, it's not as if commercial banks don't go in a fractional banking system, but commercial banks they engage in fractional banking system. And then most explain fractional banking system lẹ́ẹ̀kan. It is just the system where um, they lend out a part of customer deposit to investors to invest. They don't lend out the whole. Wọ́n lọ ṣe ń pè wọ́n ní fractional. It is a fraction of gbogbo customer deposit tó bá wà lọ́wọ́ wọn. You won't lend that for investors. So they create money. Commercial banks create money through the fractional banking system. That is, they create money in the economy by what? By giving out loans that are equivalent to a fraction of the total deposit that is being saved, with them. So it's as simple as that. So only. Then it says this fraction gives insight to the monetary authority on the base money. To be honest, base money is something that's very unique to me. Masina and Motia base money. So commercial banks offer a variety of services to individuals, company, government. Well, I think these are things that you can read on your own. So Kila and Washington commercial banks, they accept customer deposits. Fine. Everybody knows that one. Then they facilitate exchanges. How? You can do electronic transactions. It's because you have commercial banks. You send them via your bank app. You didn't need to see me in person to send me money. Right? I don't have to see you in person to send you money. You never see, in person actually. So, but then they make it available through their banking apps, softwares, to like send and receive money. So you know one bit. And what are the other things? They give out loans. They store valuables for people. Then what else? They offer economic intelligence services and keeping customers' account. Economic intelligence services are financial advice. So example is financial advice. So of course, I'm not a loan. Because I'm also interested in what he wants to do. I'm interested in what the person wants to do because is something to yield the return high enough to pay back the loan itself and to pay the interest rate on it. So, and for that to happen, then commercial banks also give financial advice. So more. There any other thing that they mention that people commercial banks in ṣe tí a dẹ̀ tí ìdárúkọ ẹ̀. So ẹ kàn máa save owó. Ó ní agbára o. Well, you can also add that they facilitate the payment of salaries. They facilitate the easy payment of salaries. So they even limit financial risk. So instead of kind of company ṣe máa gbé owó kọ́ máa gba owó ní báńkì bí ní ọjọ́ Friday kọ́ lọ máa gba cash 200 million àbí cash 50 million kọ́ ṣe máa fi sínú envelope wọ́n máa fi san salary àwọn òṣìṣẹ́. You don't need all of that now. So also my program already. So banks will be the one that will just do all of the payments on behalf of those companies. So that's also one thing that they do, which makes sense. So and they limit finance. So they limit robbery by trying to carry cash, up and down. So etc like that. So we now have a credit creation in the modern banking system. Credit creation refers to how commercial banks create money òun dẹ̀ mo ti ń ṣàlàyé látẹ̀ẹ̀kan náà. So nǹkan tó fẹ́ sọ mí báyìí nìyẹn. So one of the major distinguishing characteristics of commercial banks among other financial institutions is that they can create money. This literally implies that it can increase the supply of money by granting loans or credits. How does the central bank create money? Question. How does the central bank create money? Thank you very much. And how does the commercial bank create money? How does the commercial bank create money? By giving out loans. So thank you very much, ma'am. So it is better to understand that differences. So historically, this practice can be traced to the early goldsmiths who learned that they could lend out part of the gold that has been deposited with them. Elena la Solano. At a time gold goldsmith were for receipt. Everybody was now comfortable just exchanging receipts for goods and services. And Baba Kazeem, go the new one that receipt bá ti fún wọn afọ ní góòdì yẹn. So dáì náà bá dẹ̀ ti dé ọ̀dọ̀ bàbá Kazeem tó ti sọ pé góòdì tẹ́tí confam ẹ̀ ẹ̀ náà wà ní wo ẹ̀dílẹ̀ ẹ̀ náà máa mú receipt ẹ̀ máa mú káàkiri náà lẹ̀ máa fi rà kan. So góòdì máa ń pọ̀ lọ́wọ́ goldsmith. So goldsmith now realized that they could use the gold to do other things. So they come and stockpile because people are not coming for them, not coming receipts káàkiri ni. So historically, the practice can be traced to the early goldsmiths who learned that they could lend out parts of the gold that has been deposited with them. This was possible since the entire gold deposits look alike, and since gold is a homogeneous commodity. One person's gold on deposit could be retrieved by the owner on the presentation of the receipt, but it doesn't have to be the very same gold which have been deposited. Gold is gold now. If I'm gold of a particular value, sort of goldsmith, he can give another gold, but like gold is homogeneous, so it's not as if only out of only different color or something. So mo fẹ́ gold fún mi gold padà ó ti tán. But it doesn't have to be the very same gold which have been deposited. So since not all depositors were likely to demand their gold at the same time, the goldsmiths realized they could make fast money through prudent lending of a fraction of the gold for safekeeping. So nǹkan táwọn báńkì náà ṣe náà nìyẹn tó fi di pé owó pọ̀ ní báńkì, owó pọ̀. In fact, èmi gan ti apply sí báńkì gan ní ọdún yìí. Ayé tó bí báńkì bí mélòó kan. Ibi akéwì náà ṣe lọ ṣiṣẹ́ báńkì. Kí n wọlé through graduate training kí n máa jẹ owó tí wọ́n jẹ ní báńkì náà. Ọlọ́run náà ni ò gbà fún yàn. Ọlọ́run ní títí yìí náà lọ́nà ẹ̀. Báwo ni mo ṣe fẹ́ bá mo máa díjọ kẹ́ pàdé ẹ̀sìn tó bá kí mo ti wá. So báwo ni bàbá mo máa díjọ kẹ́ pàdé tó bá kí báńkì ni mo wà ń sìn. So but then ọ̀nà tí oníkálukú wá wà. It was because of uncertainty too actually that time. So not that ọ̀nà tí yàn wá pé kò sówó ń bẹ. Although bí àwọn ṣe ń wò kò sówó ń bẹ tó owó tí yàn rí from banks. But then I realized that God can give you wisdom that will make you to generate more money on your own as a side hustle, different from what you're even getting from a normal salary. And the thing about fi gbogbo ẹ̀ pọ̀, kí yàn má fi orí Ọlọ́run pamọ́, ó lè ju iye tẹ́lẹ̀ mi gan gbà ní báńkì lọ under a lot of stress and etc like that. So ìyẹn náà wà lára ẹ̀. Continue from there. Let us now walk through carefully how a modern commercial bank creates money by an efficient example. It should be an efficient example of the early Goldsmith principle of fractional lending. Fractional. So fractional it is because it is a part of the entire customer deposit in one lender, not everything. We're not saying fractional. Now, the following assumption will enable us to see without complications how this process of money creation works. A, we assume that there are 10 commercial banks in the hypothetical economy named Bakari City. This assumption is to enable us to deal with the realistic situation where there can be many banks in the economy. All commercial banks in Bakari City are required to keep a certain percentage of deposit with them as cash. This is the cash. Specific to be reserved, which shall be called 10%. There is no leakage in the sense that any can withdraw láti lọ fi jẹun. of currency, either outside the economy or into non-bank savings transaction, etc. Each commercial bank stands ready to grant loans to its eligible customers on request. So this assumption, just to simplify things, not like a cold assumption. So we now have the following. The first bank, wọ́n fi 550,000 síbẹ̀, that's stage one, Bank of Patriots. Ṣé ẹ ti rí page yẹn? Okay, so Bank of Patriots, wọ́n fi 50k síbẹ̀. Required ratio is 10%. 10% of 50k is 5,000. So kí ni loan tí business yìí lè grant? 45,000 naira loan, that is excess reserve lélẹ̀. So in this place, we'll consider liquidity ratio. Like I said, what can really consider? I don't think they don't really consider liquidity ratio ní àwọn solutions that even textbooks. But me, I just think that in the real world, it is something that they are going to be considering. Yeah, I'm happy now pàdé mi tó wà ní banks, so to know what they actually do. But I'm okay, textbook show ó kàn máa fẹ́ simplify nǹkan so that people can get the basic thing that is being taught before things are now being made complex. So yeah, it is only cash reserve ratio now. So 5,000 naira has been saved with the central bank, 45,000. So 45,000, the bank will lend out. So the bank lends out the 45,000. Fún ẹnìkan, ẹni báńkì stage 2, ẹni yẹn lo Baki International Bank. So ẹni yẹn lo Baki International Bank. Now, nínú yẹn sìn, so he has to like save 10% too. So bá save 10%, that bank needs to save 10% of that money. So on and on, bẹ́ẹ̀ yẹn, iye tó kù is 40,500. So owó yẹn tún wọnú account ẹlòmíì, because even tẹ́ bá yáwó, wọ́n máa send owó yẹn sínú bank account náà ni. Tó yẹn bá ṣe wọnú bank account gbàm báyìí, that particular bank náà máa tún san the required reserve kúrò nínú owó yẹn. Balance tó kù lòun náà tún lè lend. So tẹ́lẹ̀ mi bá tún fẹ́ yá owó yẹn ní stage 4. Stage 3 bank máa send owó yẹn sínú bank of the person ní stage 4. So ìyẹn náà, the reserve ratio will work on it on and on like that. So ó máa continue for a very long time. So tẹ́ bá rí nǹkan tó wà níbí, the total 50,000 òun ni stage 1 bank ló fi bẹ̀rẹ̀, but the total amount of money created at the end of the day was 500,000. By the time tó wí yẹn lọ káàkiri, because nǹkan tó ń pè ní total amount of money pé deposit yẹn, máa add gbogbo àwọn deposit yẹn pọ̀, máa add mọ̀ pọ̀ títí. The process yẹn máa ń gùn gan, ibi tó stop sí kọ́ lélẹ́yìí o. I will send you a video on money creation tí mo ṣe, so you now see it is a long process. So the final person máa jẹ́ 0, ibi tó ti máa stop nìyẹn. Very long process. So the more the banks involved, the more the process is going to be. Even the higher the money involved, the more the process is going to be. So 500,000 naira was created out of 50,000 naira. So nǹkan tó ń pè ní fractional banking yẹn nìyẹn. This is how commercial banks create money, because there will be new deposits every now and then. So they created times 10 of the initial money that was put into the bank. 50k lẹ́nu kọ́kọ́ tẹ̀ fi sínú báńkì o, from that 50k, gbogbo ẹ̀dẹ́ padà workers, and you're able to get 500,000 naira from it. Now the way it is working, it is not 50,000 times 10 banks, so like bó ṣe ń ṣẹlẹ̀ kọ́ nìyẹn, but I think they've just summarized the whole thing here to make things easier. So ó dẹ̀ wá ní formula. So because the table is a long thing, so you can't, like you are going to see it when I send you the video. So the table is a long thing, so it's not like in your call a table up and down. So what you can now do is that you can apply the formula. And the formula is the money supply is equal to 1 over 1 minus R. The money supply is equal to 1 over 1 minus R times something, money of 1 over 1 minus R times the deposit. I think that's the formula. 1 over 1 minus R times deposit. So 1 over 1 minus R ló wọ́n pè ní money multiplier. Wọ́n ti ṣe government spending multiplier sẹ́yìn, a ti ṣe investment multiplier sẹ́yìn under simple economy. So money multiplier náà ní formula. So the formula for money multiplier is 1 over 1 minus R, where the R is the cash reserve. The R is the cash reserve. I don't know if the person follow me, ma. Okay. So from there, um, kí ni formula tí wọ́n lò? Excess reserve is 1 minus R. What she gets is 500k. So is it even okay? 1 over 1 minus R times change in deposit. Is it? I think it is change in deposit. Change in money supply. Where is it again? I think it should be easy. Hold on, Sham. Change in money supply is equal to Killeri. Abi 1 over 1 minus R. Cash equivalent cash reserve ratio straight bear ratio, then multiplied by deposit change in deposit. Change in deposit. So táwa fẹ́ kọ ní mathematical terms. So I want you to note this formula. So change in money supply is equal to 1 over this. So by how much is the money supply changing if there's a change in deposit? So táwa fẹ́ lo calculation that ṣe ń sìn. Change in money supply equals to 1 over 1 minus the reserve ratio was 10%, which is 0.1. She understand, ma? I understand, Abi. Okay. Then the change in customer deposit is 50. So before that time, or let me just call it 50 minus 0. Before that time, because the deposit kokon, and now there is a deposit, so it is 50 minus 0. What is send here? No. So change in money supply equals 1 over 0.9. 1 over 0.9, then multiplied by 50. And change in money supply equals to 1 over 0.9 should be 1 divided by 0.9, 1.11. What do I think back on the layer? I should be getting something like 450. What's a mistake formula? We now have factors affecting the creation of credit. Kí làwọn factors tó máa affect ẹ̀? All ti sọ́nà lókè náà tẹ́lẹ̀. Gbogbo àwọn reserve ratio máa affect ẹ̀. All those that we discussed up here before. Reserve ratio, liquidity ratio, customers' desire to hold money or to keep money in banks, but level of bank reserves, etc. They will all affect how much money that the commercial banks can create. So although they may have mentioned different points here, I'll quick on the central banks control via the reserve ratio. So this one is talking about reserve ratio. So it's say about increased reserve ratio, about lower reserve ratio, it is going to affect it, the amount of money that they can work with. Then currency drain from the banking system. Eléyìí mean pé owó tí wọ́n jẹ́ kó wà available for lending purposes, because banks can create a lot of money when they have excess reserves, but if people are withdrawing their money, so it's not going to work. At the sudden, not it is expected that all transactions should be done through the banking system, through the use of check or bank transfer. You add bank transfer, but some transactions are actually done outside the banking system. Therefore, the more transactions are done outside the banking system, the less the system creates money and vice versa. And we've spoken about this one, so it's not a big deal. Then you have banks' unwillingness to lend. Now, to create money, banks must also be willing to lend money to those who want it. But the bank máa fẹ́ yá òyìn lówó náà kan. So ìyẹn náà wà. Purpose kí bank máa fẹ́ yá òyìn lówó. So níbi bá ti di pé òkè o, àwọn tó fẹ́ wá gbowó, wọn ò ní collateral láti fi gbowó. Ṣé bank máa yá wọn ni? So because tá bá yá yín sí, a mọ̀ pé kò sáà ṣe láti máa lè dá padà, bank will not lend you. Or if you don't really have o fẹ́ yáwó nísìnyí, wọ́n á fẹ́ lọ fowó ṣe wedding. ṣé wedding wà profit generating ni? Profit wo ló fẹ́ lórí wedding tó máa fi jẹ́ kí báńkì yá lówó láti lọ fi ṣe wedding? They will not lend you that kind of money too. So banks may be unwilling to lend, and if they don't lend, it limits their ability to like create money. Then government credit guidelines. To get government credit guidelines in the government control over disbursement of funds by the bank system. This has a lot to do with money creation by the banking system. See guideline láti máa fi já owó or láti máa fi já owó see láti máa fi já owó from banks. If the guidelines are strict, well, it may not encourage people to come for loans. So, and then that is going to also going to affect. Okay? So we have unwillingness on the part of the public to borrow. So táwọn èèyàn bá fẹ́ yáwó ńkọ́, owó wà ìwá yáwó ẹbí ṣòwò táwọn èèyàn bá láwọn ìyàwó ńkọ́. Ẹ wo orú period tá wà ń sìn. Tẹ bá fẹ́ yẹ́ lómi lówó kò ní gbà. Why? Because ó lè ti rò pé business wo lòun fẹ́ ṣe tó wọ̀n náà ní wọgbó. Ṣé lè tẹ́ pé imagine pé ẹ fẹ́ já owó láti máa fi ta ṣe business bí a boutique ẹ máa ṣe luxury items in an economy tẹ́ pé people are barely striving to feed themselves. So you may just want to like keep the business plan on hold until the economy gets better, so that àwọn tó lè patronize àwọn tí máa ní owó dáadáa gbà láti máa fi ro pé okay expensive clothes ni ó kàn fáwọn láti máa rà instead of food. So that's about that. The rest is now financial intermediation function of commercial bank. So you can read up this one and then continue from here tomorrow. As we are now, page 136.